The 20 and 30-year Treasuries held steady around 5% this week. What's pushing long bond yields up so much? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly bond update. We've returned home from Taipei, as you can see from my bookcase background. So, CPIU inflation came in as the market expected, but still a bit higher than last month. According to many headlines, President Trump's tariffs are what drove the uptick in prices. From the New York Times, U.S. inflation accelerated in June as Trump's tariffs pushed up prices. Let's dig a bit deeper into this, as we like doing here at Diamond NestEgg, because as sometimes happens these days, the story is not as straightforward as it may seem. And with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Are some imported items such as smartphones and televisions now more expensive than they were a year ago? Or are they actually cheaper? And why? And how did markets react to the past few days' news on tariffs, inflation, and a potential new Fed chairman? 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? As usual, here's our front video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Are some imported items such as smartphones and televisions now more expensive than they were a year ago? Or are they actually cheaper? And why? The U.S. economy had good news for us this past week. The University of Michigan Survey of Consumer Sentiment showed that all 3 of their key indicators, consumer sentiment, current economic conditions, and consumer expectations, continued to improve month on month. For current economic conditions, the numbers are now 6.5% better than they were a year ago. Consumer sentiment and expectations are still lower, though. According to Seeking Alpha, the hard data also confirms an improving economic climate as U.S. retail sales grew 0.6% month over month to $720.1 billion in June, surpassing the plus 0.1% consensus and reversing from the 0.9% unrevised drop in May. On a year-over-year basis, June retail sales climbed 3.9%, accelerating from plus 3.3% in May. And some of the biggest companies that have reported earnings to date have surprised to the upside and or given positive guidance for the rest of the year, including PepsiCo, United Airlines, and TSMC, Taiwan's semiconductor manufacturing company. So, against this generally positive backdrop, it shouldn't come as a surprise that economists lowered the likelihood of a recession in the next 12 months to 33%, down from 45% in April in the latest Wall Street Journal survey. This may have contributed to a very good week for equity markets. The S&P 500 and the NASDAQ Composite both closed at new record highs on Friday, with the Dow Industrials not quite there yet, but not far behind either. That said, despite, or maybe just because of all this good news, a lot of the discussions in the media were about the possible downside risks. Could this all just be a midsummer night's dream? And might we wake up to much less benign or even a frosty economic climate when everyone returns to school in late August and early September? And there are clearly some risks out there. President Trump continues to make noises about maybe trying to fire or maybe not trying to fire Fed Chairman Powell. The dollar is weaker now by 5.65% at the time of this taping than it was a year ago. And maybe the biggest point of discussion currently, the negotiations with our partners about new trade agreements have been dragging on, with no immediate clarity in sight as far as we can tell. In the meantime, the Yale Budget Lab estimates that at the time of this taping, consumers face an overall average effective tariff rate of 20.6%, the highest since 1910. It's no surprise then that the latest inflation data has been carefully scrutinized about what it could possibly be telling us about the impact of tariffs on inflation. Now, the latest Consumer Price Index for all urban consumers, or CPIU for short, that the Bureau of Labor Statistics released this week, showed the 12-month inflation rate at 2.7%, in line with expectations. And the less volatile core inflation picked up 0.2% on the month, with the annual rate moving to 2.9%, in line with estimates, as CNBC reports. Which was not such a bad reading overall, a bit above the Fed's target of 2%, but so far relatively stable and a far cry from the peaks we saw after COVID. But to get back to our question from the beginning of this video, can we already see signs of the impact of Trump's tariffs in the data, as the New York Times and many other media sources suspect? The Bureau of Labor Statistics doesn't think so, or at least they see other factors as the main drivers for the latest inflation numbers. As they say in their press release, the index for shelter rose 0.2% in June and was the primary factor in the all items monthly increase. The energy index rose 0.9% in June, as the gasoline index increased 1% over the month. The index for food increased 0.3%, as the index for food at home rose 0.3%, and the index for food away from home rose 0.4% in June. And neither shelter, housing, nor gasoline, or the more than 80% of food produced in the U.S., are really subject to tariffs. Other factors such as interest rates, average wages, and fluctuations in global market prices for food and commodities can probably explain these price increases better. But let's dig into the details a bit further, as we promised you we would at the beginning. So, if we take a look at some of the spending categories with the largest price increases, we can see that just a few of these items that are now more expensive may be substantially impacted by Trump's new tariffs. We suspect these might be mostly audio equipment and laundry equipment here. And maybe coffee, but that's been experiencing overall very high and rising global market prices currently anyway. And perhaps a certain part of the other categories may be imported and subject to tariffs. But all of these are generally not the usual suspects for tariff-induced price increases. For example, as far as we know, eggs are mostly produced domestically. And yes, egg prices have come down a lot, but they are still higher than a year ago, and it even puts eggs at the top of this list. Now, let's look at the other side of the range, at some of the items with the largest price decreases versus a year ago. And this list really surprised me. Personally, I was not expecting to find items that are to a large degree imported to have become noticeably cheaper versus a year ago, like sewing machines, smartphones, televisions, telephone hardware, and calculators, as well as dishes and flatware here. And the headwinds didn't just come from Trump's tariffs, but from a weakening dollar as well. That said, please keep in mind that these snapshots here are not representative of the entire universe of the U.S. economy. Our point is rather that the relationship between tariffs and inflation, at least so far, may not always be as straightforward as many seem to think. But who knows, maybe the next inflation readings will show completely different numbers. We can't predict the future either. And remember when we said earlier that some of the biggest companies that have reported earnings to date have surprised to the upside and or given positive guidance for the rest of the year. According to this Wall Street Journal article, these are all tariff-sensitive companies, and they've had all good earnings, good guidance. Yahoo Finance even reports that Wall Street banks and their clients are moving on from Trump's tariff chaos. Top bank executives repeatedly made it clear this week that their corporate clients are becoming used to the uncertainty surrounding trade and are moving ahead with plans to merge with other companies, raise debt, or go public anyway. Drop a comment below. What do you think? Have you personally moved on from tariff uncertainty as well? Or are you more pessimistic about the state of our economy than the upbeat macro data would lead us to suspect? And why would imports that are subject to new tariffs actually be cheaper now than they were a year ago? We have some hypotheses of our own, but we'll need to do a bit more digging first on our end. But perhaps you might have an explanation or hypothesis that could explain this riddle. So, now that we've dissected the real data and facts from this week's biggest pieces of news, let's move on to bonds and how they reacted to this eventful week. Which treasuries rose the most and which ones fell this past week? Here's our usual table with treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. While equities reached new all-time highs last week, as we discussed before, the bond market seems to have been completely unimpressed. In fact, this was one of the least eventful weeks for Treasuries in a long time, and most maturities moved by 1 or 2 basis points only, if at all. And while the 30 years yield increased by 4 basis points wasn't that dramatic either, it did bring us back to exactly 5% at the end of the week, the first time it closed a week with a 5 handle since May 23rd. And despite President Trump's ongoing and quite public pressure on Fed Chairman Powell to start lowering rates, the CME Fed Watch tool also hasn't changed that much. If anything, it indicates that markets think it's become even a bit more likely that the Fed will leave rates where they are in the next FOMC meeting on July 30th. This 95.3% here is slightly up from the 93.3% a week ago. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. In line with an uneventful week in the bond market, the overall picture versus the beginning of the year hasn't really changed that much. At the long end of the range, the maturities between 1 and 10 years are down against the beginning of the year, while the 20-year and 30-year are up. And if we ignore the 1 year and the 2 year as outliers, this means that as a result, all maturities from 3 years to 30 years now line up in a somewhat normal-looking positive yield curve that may signal market expectations of continued economic growth and maybe a bit of inflation as well. At the short end, the 1 month and the 1.5 month seem to have almost fallen back in line, more or less, and all maturities under 1 year now trade in a narrow range of yields between 4.3% and 4.46%, which is clearly too high compared to the maturities at the long end for the 3 year and longer if one was to expect a more normal yield curve. So perhaps the Treasury market is just in a holding pattern at the short end, so to speak. And if and when the Fed were to finally lower its Fed funds overnight target rate, we might be back to a positively sloping yield curve across all maturities for the first time in a few years. Assuming the 1 year and the 2 year, which are outliers here, can make up their mind as well, of course. Now, I'm not holding my breath for that to happen too soon. But in the meantime, you can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, let's move on to the next Treasury auctions. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 20-year T-bond and the 10-year TIPS will also be auctioned off this coming week. The 20-year T-bond is a reopening auction, so we already know the coupon on that. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 20-year T-bond auction. And here's the coupon and the expected yield for the 10-year TIPS auction. And as a point of reference, this expected yield is higher than the current fixed rate on an I-bond. So if you're comfortable with TIPS, this may be something to take a closer look at. Bond beginners, folks, please refer back to these two modules here on TIPS and I-bonds for a refresher. The break-even inflation rate on the 10-year TIPS was 2.41% at the close of market on July 18th, which is in line with the break-even inflation rates on 10-year TIPS for all the years post-COVID, but a fair bit higher than the break-even inflation rates that we've seen on the 10-year TIPS in the years pre-COVID. And as we mentioned earlier, the latest BLS inflation report showed annual inflation coming in at 2.7%. So if the 10-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 10 years will average more than 2.41% annually, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, members, super savers, and bond course fans, I hope you enjoyed today's video and learned something new. And for those of you who subscribe to Your Financial Journey, check out this latest video here from Caitlin on how many Americans actually have $1 million or more. And as always, if you want to learn more about bond investing and building out a bond portfolio where rates are still attractive, then check out this video here on our bond courses. I've also linked all the details on Caitlin's video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.